Hello, everyone. Thanks for joining us today for our webinar on the Employee Retention Credit, or ERC. Before we get started, I want to let you know that following today's webinar, you'll receive an email with a link to the recording of the presentation. Also, if you have any questions during the webinar, please type them in the questions box in the right panel, and we'll get to as many as we can at the end. I'm Michael Matalone, Director of Business Sales here at GTM Payroll Services. I'll be turning the presentation over to Jim Foster from HireTech to help explain and provide details about the ERC. But first, just a quick word about GTM. GTM was founded 30 years ago and is headquartered in Clifton Park, New York. We offer businesses human capital management solutions backed by our expertise and local support. And that's what sets GTM apart. When you call GTM, you're calling directly to your account manager and not a call center. We partner with iSolve, which provides state-of-the-art HCM solutions. And there are opportunities to train and learn through an online university and our in-house training facility in Clifton Park. And here's a quick look at iSolve's components, everything from hire to retire in one cloud-based database. Payroll, human resources, benefits enrollment, learning management solutions, rewards recognition and employee engagement, onboarding, applicant tracking, time and attendance, and more. All employee data accessible with a single login 24/7 from anywhere. And now a brief look at the options that GTM clients have for obtaining the ERC. You should talk to your accountant about the ERC. We can work with them to do the amended returns. For our clients, there are some specific reports within the iSolve platform that will help with the needed information. Or if you're looking for a full-service solution to help determine eligibility and maximize your credit, we can outsource to a company like HireTech. And if you're not a GTM client, one of our partners may be able to assist you with the ERC. And now I'd like to welcome Jim Foster, Director at HireTech. Jim specializes in tax credits and incentives, including the ERC, and has also worked on disaster relief credits. After obtaining his JD from South Texas College of Law, he worked for a national tax consulting firm before joining HireTech. Jim has been practicing law for more than 14 years with a proven record of successful tax cases. Jim, thanks for joining us today to share your expertise, and welcome.
Thank you very much, Michael. So just to give you a little bit of an agenda today, we're going to do an overview of the ERC, just kind of high level, what is it and how it affects you. Then we're going to dive into the rules for 2020, which is where we really need to start our basis for understanding the ERC. Then we'll go into the 2021 changes. Afterwards, we'll discuss what wages we can actually qualify towards the credit, and then a few exclusions that we need to worry about. And then finally, we'll open this up to a Q&A session. As I said, if you have questions as we go through, type them in the questions box, and then we'll get to them at the end of the presentation. Okay, so what is the Employee Retention Credit? This is a fully refundable payroll tax credit to incentivize the retention of employees during the time affected by government-ordered shutdowns or with a significant decline in gross receipts due to the coronavirus. Now, what the government is saying here is while you are affected by the coronavirus, we want to incentivize employers that actually maintained or even expanded their employee base. Even if you have a reduced employee base, you can still claim this credit. And so it's basically helping out the small businesses that were able to stay in business during these hard times. There are some caveats for larger businesses that we'll go through, but this is primarily a small business credit. So the ERC actually, instead of going on to the normal income tax return, goes on to your quarterly payroll tax returns, your 941, or if you're amending onto the 941X. There is a worksheet in the 941 instructions that will help you to fill out where the employee retention credit goes on the 941. When you're looking at the 941, there's actually two lines for the employee retention credit. There's the non-refundable employee retention credit and the refundable employee retention credit. And basically what this is The non-refundable portion is the portion that's offsetting your tax liability. And then the refundable portion is the portion that you're going to get back in the form of a refund check. At the end of the day, what we are looking at here is you're going to get the entire amount back in the form of a refund check from the government, unless you are filing for the credit contemporaneously as you go through the quarter, which I don't recommend doing because there are certain exclusions such as the PPP that we need to take into account, and some of that we won't know until the wages are done at the end of the quarter. And so we recommend figuring out the ERC at the end of the quarter to make sure that everything is correct. All right, so let's start off with the basic qualifications for the employee retention credit as of 2020. And this mostly applies to 2021 as well. Okay, so an eligible employer is one that carries on trade or business during the calendar year 2020 or 2021, including tax-exempt organizations that either had a fully or partially suspended business during calendar quarter in 2020 or experienced a significant decline in gross receipts. For the full or partial suspension, it has to be due to orders from an appropriate governmental authority. So this means any federal, state, city, county authority limiting commerce, travel, or group meetings. And group meetings are defined as anything for commercial, social, religious, or other purposes. And there's quite a bit that you can fit into there when you're doing the qualification. And this is all due to COVID-19. So if the government order is restricting your business operations in some way, and you can say that it has more than a nominal effect on your business, then you have a full or partial suspension here. Now, significant decline in gross receipts. So what you do is, if in 2020 you compare the quarter you're looking at against the same quarter in 2019 and you had more than a 50% drop, that quarter is then qualified. You then get to qualify every subsequent quarter until you reach a quarter that is more than 80% of the gross receipts compared to the same quarter in 19. That last quarter also is qualified. So you look at 2020's Q2 gross receipts compared to Q2 2019 and look to see if you have that 50% drop. If you do, you're qualified. If you don't, you move on to Q3. Do the same comparison. Let's say that you had the 50% drop in Q2 and you had a 75% drop in Q3. Well, then Q2 and Q3 are qualified, and Q4 is going to be qualified no matter what, if it's over or under that 80% mark, because we get to include the last quarter there. So this is how you're going to qualify in 2020. Let's go ahead and go to the next slide. So as I was saying, you're going to be doing that comparison from 2020 to 2019, and it's a direct look back. You are not going to be looking at Q1 of 2020 as the program did not get started until March 13th, 2020, and the excuse me, the first quarter that you get to do this gross receipts test is with Q2. I'm leaving the slide here just so you can go ahead and see where we're talking about, and you can review this later. All right, next slide. All right, so the next thing you have to do for qualification is you have to determine your monthly average number of full-time employees for 2019. And please note, this is full-time employees, not full-time equivalents. You are going to calculate the number of employees that work 30 hours a week on average in each month, or 130 hours for the month for each month. You then average that across the 12 months. If that number is less than or equal to 100, then you get to qualify your entire payroll, provided that you met the gross receipts test or the full or partial suspension test, for the employee retention credit. Now, there are some exclusions, such as owners with more than 50%, priests and ministers, and some other caveats, but otherwise you get to take the entire payroll. If the number is greater than 100, then you only get to qualify individuals who are paid not to work. Now, this does include healthcare premiums for individuals on furlough. So if you have furloughed employees, but you paid for their insurance premiums, we can qualify that. Now, additionally, what we've seen is with large companies, with several thousand employees, a lot of times there are locations that were affected by COVID for a few days or something, where they had to shut down the office, and the employees still received a paycheck, but they weren't able to work. When you add all those up, it can equal a significant credit, but you do have to look at these individuals who are paid not to work, and those are the only ones you get to qualify for the time that they did not work, not the entire quarter. Now, when you have multiple FEINs, meaning multiple companies, you do need to do a control group analysis. And when I say a controlled group analysis, the ERC has its own definition of what is a controlled group for the ERC. And if you meet that test, then you have to do both the over-under 100 analysis and the gross receipts test at the control group level, meaning you have to aggregate all those entities that are within the control group. This is extremely important if you are doing the ERC, because if you follow all the caveats and the rules that were set out in the code and what the IRS is saying and everything else, this is mostly a black and white credit. The catch is there's a lot of the rules and caveats and everything else, so you have to know everything inside and out. If you do that, then you won't run afoul of the IRS if you're ever audited. One of the things that the IRS is going to do, though, is say, did you do a control group analysis? And if you did not, they're going to say, okay, credit denied. Here's your bill for the credit we gave you, as well as all the interest and everything on it. So as far as quantification, the employee retention credit for 2020 is a 50% credit on the first $10,000 in qualified wages, including healthcare premiums paid by the employer for the year. So that means that you can have a max credit of $5,000 per employee in 2020. This adds up very quickly, because even though we had to do that full-time employee count for purposes of qualification, once you get into it, you can qualify everybody on the payroll, which includes part-time employees. And those employees add up very quickly. So what ends up happening is this credit will wipe out your Social Security tax and give you a refundable portion that's very significant. I would say that we probably have done over 1,000 clients at this point, or somewhere in that ballpark. And the average 2020 credit was a solid 6 figures. It's ranged from very, very little to 8 figures. But it's a very significant credit that we're seeing for most of our clients. All right, so 2021 changes. The original law did not allow a taxpayer to take both the Paycheck Protection Program and the Employee Retention Credit. You had to pick one or the other. Most people chose to do the PPP, and I completely agree with them. The PPP, as long as you follow the rules and that they've set out for it, is basically free money from the government to cover your payroll, your rent, and your utilities, and things like that for a set period of time. At the end of 2020, there was an additional stimulus package passed that said you could take both. So everybody that followed the PPP and said, oh, I can't take the ERC, is now able to look at the 2020 ERC credit. And it was made retroactive for 2020. It wasn't just on a prospective basis for 2021. So when we're looking at this now, you have to go through and make sure that your PPP is taken into account when doing the ERC, but you can take both. You just can't take them on the same wages. Now, for 2021, they increased the credit amount from a 50% credit per year to a 70% credit per quarter. So on the first 10,000 in qualified wages. So what this means is you have a maximum $7,000 credit per employee per quarter. 2021 Q1 was very lucrative for our clients. We saw very significant credits across the board. I would say the average credit was probably between 120 and 150,000, with outliers across the board. And 120 to 150,000 was for a relatively small shop. They changed the gross receipts test from a 50% decrease to a 20% decrease. And they allowed you to look at, instead of having to wait until the end of the quarter to figure out if you met this gross receipts test and then scramble to do your credit, they said, hey, you can look at the prior quarter and compare that same quarter to its equivalent in 2019 to determine if you meet the gross receipts test. Finally, the other big piece that was done is that they changed the over-under 100 full-time employees test to an over-under 500 full-time employees test for 2021 calculations. So what this means is you do that same monthly average calculation in 2019 across all 12 months. And if you're over under 500, if you're under 500, you get to take the entire payroll. Now, there is one other piece that changed with the most recent stimulus package. Up through Q2 2021, the ERC is offsetting your Social Security taxes, and then the rest is refundable. Starting with Q3 2021, it's going to offset Medicare taxes, and the rest is going to be refundable. So you may end up still having to pay your Social Security taxes in Q3 and Q4 of 2021, but you are going to get this credit back in the form of a refund, which should more than help pay you for your taxes there. Okay, so I want to go over this a little bit more in depth here. So if we look at the blue arrow, we can compare Q1 21 to Q1 19 and see if it had a more than a 20% drop in gross receipts, meaning the receipts were less than 80% of when doing the comparison. If so, Q1 is qualified of 21. Alternatively, we can look at the green arrow where we compare the prior quarter to the quarter we're calculating, which would be Q4, and compare it to the same quarter in 2019, which would be Q4 19, and do that comparison and see if they had that 20% drop. Finally, if you were not founded prior to Q1 2019, you can do a comparison of 21 to 20 and see if you qualify that way. So for companies that were founded in mid-19 or in 2020 or something like that, you can do the comparison to 2020. Now, when doing Q2 21, you're going to do a comparison of Q2 21 to Q2 19, or a comparison of Q1 21 to Q1 19, because that would be the prior quarter there. Keep this in mind, because what ends up happening is we can look at that prior quarter, see if you qualify, and if you do, great. If not, we can wait until the end of the quarter and see if your current quarter qualifies or not. Now, if your gross receipts for Q1 21 are less than 80% of the same quarter in 2019, you get to qualify not only Q1 21, but you also get Q2 21, because Q1 would be the prior quarter. So this is something that you want to keep an eye on, the running comparison, so you can figure out which quarters are going to be qualified. Okay, so I said that the wages that are subject to FICA, as well as qualified healthcare expenses paid by the employer, are the amounts that we can look at for the employee retention credit. Note, if you have somebody that does not pay Social Security, and we have had this come up in a handful of instances, we can't take their wages towards the ERC. Note also that the earliest pay date, and what we do is we look at the check date for the pay dates that we can look at is March 13th, 2020. That's assuming that you're underneath the government order, or you have the Q2 gross receipts qualified for Q2 2020. If so, you get to go for March 13th forward, and you get to keep going until you are no longer affected by government order, or you fail the gross receipts test. Now, the qualification on the orders and the gross receipts is done on a quarter-by-quarter basis. It is theoretically possible, and I have seen it happen, where Q2 qualified and Q4 qualified, but Q3 did not. It's not very common, but you want to do this analysis for each quarter while this program is in existence. Now, a big one that affects people is you cannot take into account owners with more than 50% ownership. And when calculating that 50% ownership, you have to aggregate husband and wife's ownership together to see if it's more than 50. So if you had a husband and wife that were 50 split partners in the business, that's actually considered 100%, and they would be excluded. Alternatively, if you had two partners that were unrelated, that were 50-50 partners, we could actually include both the owner's wages into the calculation. Now, additionally, we cannot take into account certain familial relations to owners with more than 50%. So if you have family on staff of the owner, then most likely they're going to be excluded from the calculation. Kids are excluded, things like that. So we have to make sure that we get all those familial relations to the owner. And we're talking about blood relations. If it's the in-laws or anything like that, we don't have to worry about it. Finally, if you're qualifying a church, which we have many churches signed up for this, you cannot take into account priests, ministers, or pastors, as they are exempt from Social Security. They have their own retirement funds and everything else set up, so they're able to get out of Social Security. One of the things that I want to point out here is that you want to maximize the amounts that you can here when looking at this. So when you're looking at the wages, you want to take both the wages and the healthcare expenses as they are generated, so that you can hit that 10,000 cap as quick as possible. That way, if the IRS audits you and says, oh, here, this wage didn't qualify, you could say, well, that's fine because we had these other wages that would have qualified in its stead. That way, you are maximizing the credit and you're preparing yourselves for audit in a worst case scenario. Okay, now for the exclusions. And the exclusions are very important. They don't want double dipping on the same wages for the ERC and PPP. So if you take the PPP and you have not filed for your forgiveness yet, I highly recommend that you talk with your banker and see if you can allocate as much to the rent and utilities as possible and thereby lower the amount of wages that are being allocated to the PPP, because those wages that are being paid for by the PPP, we cannot take into account for the ERC. And we've actually developed a proprietary algorithm to maximize the ERC while ensuring that the PPP is taken into account. For example, if you have a more than 50% owner, you want to allocate as much of the PPP to that owner as possible because their wages don't qualify for the ERC, thereby reducing the amount of PPP wages that we have to apply to other employees. Another one is the WOTC program, the Work Opportunity Tax Credit. You cannot take the WOTC and the ERC on the same wages. The PPP is the best program here, so if you're able to qualify for it, take it. If you can't qualify for it, then you want to do the ERC, and if you can't take, and then after ERC, then you want to take WOTC. I do want to make note that if you are using Higher Tech for calculations of the WOTC, our system automatically adjusts the WOTC wages to account for ERC. Now, the other exclusion are what are called the COVID payroll credits, the EFMLA and the EPSLA, and I apologize, I forget what the acronyms stand for. It's Emergency Family Medical Leave Act and Emergency something. But these credits are not as lucrative, but they do need to be taken into account. So if you took any of these credits, we need to back them out from the ERC calculation. And what we do is we get the payroll report, and it'll have in there, it should have in there the EFMLA and the EPSLA amounts, and we plug those into our calculator and automatically exclude them from the ERC calculation. Now, the whole point of this is that you don't want to run afoul of the double dipping, because that's going to get you in trouble with the IRS quicker than anything else. As long as you follow the rules here and are taking these rules into account as far as which program you're using, which one you're not, you should be fine. One thing I have had come up is because they made that ERC retroactive for people that took the PPP, we had a lot of people say, well, hey, I already filed for forgiveness on my PPP loan. Can I go back and amend it to lower my wage amount for that? That's between you and your banker. As far as I'm aware, you're not able to change it once you've been forgiven. But if you haven't been forgiven, you may want to talk with your banker to see if you can make any modifications there as necessary. With that in mind, I think that's the last of my slides, or do we have one more? Nope, I'm going to toss this back to Michael and let him wrap up, and then we can dive into some Q&A.
All right, well, Jim, thank you for all that information. It's definitely a lot to take in and a lot to consider. Just a reminder before we get to your questions, for GTM, there's a couple different options for help with obtaining the ERC. Number one, you should look to talk to your accountant about the ERC. We can work with them to help amend your returns. For our clients, there are some specific reports within iSolve that will help with the needed information. Or if you're looking for a full service solution to help determine eligibility and maximize your credit, we can outsource to a company like HireTech. And if you're not a GTM client, one of our partners may be able to assist you with the ERC. And remember that we will send you a link to the recording of the presentation as well as the slides. Our contact information is on the screen if you'd like to reach us directly. And now I'll welcome Jim back as we take your questions. And Jim, just give me a second to kind of filter through because we definitely had quite a few come in.
Okay.
All right, so let's see here. Start at the top here. Okay, so the first one we've got, if I've already had my PPP forgiven for 2020, can I change the amount of wages that I took towards my PPP?
I thought somebody would ask that. And as I said, that's going to be between you and your banker. You'll need to check with them or whoever helped you with your PPP application. As far as I'm aware, once you've been forgiven, I don't think you can change it. And that's okay. What we'll do is we'll get the amount of wages that were used towards the PPP and back that out from the ERC calculation. If you haven't been forgiven, then you definitely do want to look into allocating as much to the non-payroll costs.
Okay, thanks, Jim. And here's one. Can you confirm that if we paid an employee over $10K for a quarter, that we can use the remaining wages towards PPP forgiveness?
Yes, and actually that's part of our algorithm is what you want to maximize the PPP towards those people that can't use the ERC. So if you've already hit the 10K cap, after that you want to allocate PPP funds to them to make sure that the PPP is not hurting your ERC calculation. So absolutely.
Okay. Thanks, Jim. And then do I have to amend each 941 in 2020 to claim the credit?
Short answer, yes, with one caveat. Because the program started on March 13th, 2020, the IRS said, don't file the ERC for Q1, include that amount in the Q2 941. And when you do the Q2 941 for 2020, there's actually a breakout for the Q2 portion and the March 13th to March 31st portion.
Okay. All right, I think we have time for a few more. If the owners are brothers, each with 50% ownership, can we take the credit on their wages?
Now you're getting into those familial relations, and off the top of my head, I would have to go back and review the rules there. I want to say no because you're got the blood relations there, and you'll probably have to exclude them from it because they're going to be considered more than 50. But don't quote me on that. If you are wanting to get our full service, we can definitely get your fact scenario in and look up the exact statute for that. Off the top of my head, I want to say that you won't be able to look at those two individuals, though. But don't quote me.
Okay, thanks, Jim. And then how about any idea on the general time frame of receiving the refund check once you file your 941?
That's a really good question. If it were non-COVID times, I would say 6 to 8 weeks on your 941. Because the IRS is shorthanded right now or limited due to COVID staffing, I don't know what the answer is. It's taken at least 3 to 4 months, I think, possibly longer, and that's on a timely filed 941. For an amended 941X, it's taking longer. But it varies from client to client. Some of them are getting in quicker, some are taking much longer. That would be a better question to ask your payroll company, as they're seeing the timeframes there more than we are.
Okay. And then we'll take one more here. And then does HireTech provide an audit defense on its calculations?
Actually, we do. Higher Tech, across all of its services, provides audit defense so that we stand behind our work. If you are selected for audit, you notify us. We will get a tax attorney in a power of attorney for the tax attorney to go ahead and work directly with the IRS to answer any questions they have regarding the calculation. Like I said, if you follow all of the rules and regs and everything else for this, you shouldn't have any problems. As soon as you start cutting corners and anything else, then you're going to run afoul of the IRS.
Okay. Well, Jim, thank you. And there are a ton of other questions, but I'll be sure to make sure we circle back to everyone that did post a question here and get you an answer for you. We do appreciate everybody's time, and thank you all for joining us today. And we just want to wish you guys all a great day, and thanks again. Thanks, Jim.
Thank you.